Crypto just plunged again. Billions lost overnight. Seeing your portfolio bleed red is scary, it's stressful, and it's easy to feel like the sky is falling. But I'm here to tell you something crucial. Panic will cost you far more than the market ever could. In moments like these, the decisions you make, or don't make, will define your entire crypto journey. So, before you hit that sell button, take a deep breath. Today, I'm going to walk you through 5 proven, practical steps to not just survive a crypto crash, but to navigate it with confidence, without losing your mind or your hard-earned money. First, and this is the most important step, stay calm and pause your trading. Your emotions are your worst enemy right now. That gut feeling telling you to sell everything immediately? That's fear talking, not logic. When the market is in a free fall, the worst thing you can do is make a knee-jerk decision. As the experts at 99 Bitcoins often explain, every crash has a cause. It could be a regulatory announcement, a macroeconomic shift, or even just a wave of coordinated selling. Understanding the why behind the drop helps you separate temporary panic from a fundamental, long-term problem. Think about it. How many times have we seen the market dip sharply, only to recover a few weeks or months later? Most of the time, these events are driven by short-term fear, not a market apocalypse. So, step away from the charts for a moment. Go for a walk, listen to some music, do whatever you need to do to clear your head. Do NT let a moment of panic dictate a decision that could cost you dearly in the long run? Remember, patience is a superpower in crypto. Once you've calmed down and stepped back from the ledge, it's time for step 2, assess your holdings. Not all coins are created equal, especially during a downturn. You need to look at your portfolio and categorize your assets. On one side, you have your core, blue chip holdings. Think Bitcoin and Ethereum. These are the giants of the industry, the ones with the longest track record, the most robust networks, and the highest likelihood of surviving a crypto winter. On the other side, you have your higher risk altcoins, meme-coins, or leveraged positions. These are the assets that can deliver incredible gains in a bull market but can also get wiped out in a crash. Your goal here is to reduce your risk exposure without completely abandoning your long-term strategy. Does it make sense to take small profits on a highly leveraged position to secure some capital? Should you trim some of your more speculative altcoin holdings to reallocate into your core assets later? The key is to make calculated adjustments based on your personal risk tolerance, not to liquidate your entire portfolio. Think of it as trimming the sails on a ship during a storm, not abandoning the ship altogether. Now that you have a clear picture of your portfolio, let's move on to step 3. Set alerts and identify key support levels. You can't stare at the charts 24/7. That's a recipe for burnout and anxiety. Instead, be smart and let technology work for you. Go into your trading app and set price alerts for your key assets. For example, you might want to set an alert if Bitcoin drops another 10% or 20%. This way, you're not constantly checking the price, but you'll be notified if a significant move happens that requires your attention. More importantly, you need to understand the concept of support levels. These are price points where the asset has historically found a strong base of buyers, causing the price to bounce back up. For instance, if Bitcoin is falling, you might look at previous lows or psychological price levels where it has stabilized in the past. Identifying these zones, like potential double bottom patterns where the price hits a low twice and then reverses, can give you a strategic advantage. It helps you distinguish between a continued freefall and a potential buying opportunity. You're no longer just watching a scary red line go down. You're looking for specific, data-driven zones where the market might find its footing. Step 4 is absolutely critical, especially in a down market. Avoid scams and pump-and-dump schemes. When fear and desperation are high, scammers and predators come out of the woodwork. They thrive on chaos. You'll suddenly see a flood of social media posts, Discord messages, and YouTube comments from so-called gurus promising a guaranteed win coin that will 100x while everything else is crashing. They'll tell you they have inside information or a secret trading bot. Be extremely skeptical. If it sounds too good to be true, it almost certainly is. During a market crash, your focus should be on quality, not on long-shot gambles. Before you even consider putting a single dollar into a new project, you must do your due diligence. Who is the team behind it? Are they credible and transparent? What is the project's utility and fundamental value? What does its historical performance look like? A market crash is a time to be extra defensive and protect your capital, not to throw it at shiny objects being promoted by anonymous influencers. Stick to projects with proven fundamentals and a strong community. Finally, we arrive at step 5. consider a gradual entry strategy. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." A market crash, while painful, can also present a significant opportunity for long-term investors. If you have some cash on the sidelines, capital you can afford to lose, this is the time to start thinking about buying the dip. But, and this is a huge but, you don't throw all your money in at once. Trying to perfectly time the bottom is a fool's game. Instead, the smart approach is dollar cost averaging, or DCA. This means you make small, consistent purchases as the price goes down. For example, you could set limit orders to buy a small amount of Bitcoin at several lower price points. This way, if the price keeps dropping, you continue to buy at a cheaper average cost. If it bounces back up, you've already secured a position at a discount. This methodical approach removes emotion from the equation and prevents you from making one big, potentially disastrous bet. Even the most seasoned investors follow this principle. Long-term success in crypto is built on patience, strategy, and discipline, not on impulsive, all-nothing moves. So, let's recap. Even when it feels like the entire crypto world is collapsing, not all is lost. It's crucial to maintain a historical perspective. Someone who invested just $100 in Bitcoin back in 2015 and held through multiple brutal crashes would now be sitting on thousands of dollars. The market has always recovered, and each time it has come back stronger. By staying calm, assessing your holdings logically using tools like alerts and support levels, avoiding the siren call of scams, and strategically entering the market, you can not only survive the storm but position yourself to thrive when the recovery comes. Crashes are a test of conviction, and those who pass the test are often the ones who reap the greatest rewards. If this video helped you feel a little more confident about navigating the crypto market, do me a favor and hit that subscribe button and ring the notification bell. I'll be sharing more strategies, insights, and analysis to help you become a smarter, more successful investor. Thanks for watching, and stay strong out there.